Well, after 8 interest rate hikes over the last year, many Canadians are feeling very cautious with their money. However, this may be a time to consider investing in guaranteed investment certificates, or GICs. And joining us this morning with more on this, Peter Cishecki from Everything Financial. Good morning, Peter.
Good morning, Jason. How are you today?
Good. How are you?
Doing well.
Excellent. Let's talk GICs. And why should people invest in it? Are these better than maybe investing in bonds?
Better rate of return, for sure. The people who should really look at this are more of really short-term type investments, 1, 2, 3-year type people. People who just cannot afford any volatility that the market can bring. You just can't afford to have your investments go down because you need them right away. Those are the people who might want to consider these guaranteed rates at this time.
Is there a minimum amount to spend on a GIC, and is that an appropriate term?
You can really put in any amount you want, though sometimes you do get better rates as you put more in, and you do get better rates as you go to a longer term. Realizing, though, that your money is fixed in that term, and even though your rate is guaranteed, the only other thing really guaranteed with a GIC or term deposit is when the term expires. So say it's a 3-year term. At the end of 3 years, you don't know what you're going to get. I mean, because who knows what interest rates are going to be. So you may be getting a very low or almost flat rate in 3 years from now. We don't know.
Tell us about fees. How much is it to get started in a GIC?
Well, yeah, that's a good one, Jason. People don't think there's any fees with a GIC because they don't see them. But the fee in a GIC is the difference between what the institution is giving you. So say they're giving you 5%, but let's say they're lending out that money. Like today, if you look at what it's like to borrow money, and let's say they're lending out that money at 9, 10, in some cases nowadays on non-secured loans, 11%. That's the fee, the difference between what you get and what the institution is charging. And in a lot of cases, those fees are higher than those embedded non-disclosed fees on mutual funds we always talk about. The fee on a GIC could actually be higher. You just don't see it.
Peter, how do you assess the level of risk when it comes to GICs?
That's really the own individual's thing. But it really a lot of times can be based on just your own tolerance. If the fluctuation of an account, you're looking at your statement and the account's fluctuating up and down and you can't sleep at night, I think it's safe to say you're not a high-risk taker. But also your age. If you can't afford to have your accounts go down because you're no longer working, you can't go back to work and replenish that money, you need to look at a considerably low risk level in that case. And it's really designed around your financial plan. What can you live with? And if you think, well, if I earn 5% forever and a day and I'm always going to be fine, then you look at something that is around that 5% level, because really the lower risk you take, the less volatility you have, also the less overall long-term return. But you've got to figure out what's the return you need and then assess if you're able to consider taking that risk to get that rate of return you need. But the lower you need, the less risk you have to take.
And is the rate guaranteed?
On a GIC, it is theoretically. I'll explain this real quick for you, Jason. The rate is guaranteed to the end of the term, but if you get a redeemable GIC that allows you to end the term early and cash in your money early, then they're going to do an interest rate adjustment, which means, let's say you were getting 5% for your term, but daily interest was 2 or a shorter term was 2, and you have to end that term early. Maybe you need the money for an emergency or something, and you're allowed to do that. The institution is going to adjust how much interest they give you based on what they would have given you if you actually did the shorter term. So you do have to look for that interest rate adjustment. Don't think you're going to get 5 if you cancel the term early, and that's fair because you didn't see the end of the contract, so the bank can't fulfill their obligation on the other end with how they invest the money.
GICs for dummies. Peter, thank you so much for taking us through that.
You're welcome, Jason. GICs 101.